Hey everyone, happy Wednesday. Hope you're all well. Hope you had a great bank holiday weekend. We're now into May. The year is going quick. Another edition of #askrobco with James Wild. How are you, James? Good bank holiday?
Yeah, really good. Thanks, Rob. Really good. And the weather stayed pretty good for us as well, which was positive.
Yeah, I thought it was going to be a washout and it ended up not being. Okay, so welcome everyone. Hope you're all well. Lots of good data and good updates. Another week in the property market. Let's just go straight into our intel and data that we update everyone with on a weekly basis. Let's see what's been happening in the last week, see what trends there are. So handout number one on the right-hand side, week commencing Monday, the 26th of April, week 17 of 2021. New instructions for the 350 figure, still very steady Eddie. It's been that way for a little while now, not reaching the figures of last year. And what that is telling us is there is a lack of stock on the market. And we're going to discuss what that means, demand and supply, basic economics. In terms of sold figures, 131, again, it's been very steady for the last month in the low 100s, nowhere near the 200 plus that we were seeing at the back end of last year. And again, that's just a reflection of where the market is at the moment. James, what do you want to add on that? Just very steady numbers, very consistent week on week on week at the moment.
Yeah, no, very steady, Rob. Much the same figures this week as to last week, much the sort of status quo. Like we were saying last week, I do think that May and June will be busy months and they will take advantage, buyers will take advantage of the sort of tax incentives by the government, that extended stamp duty holiday on the first £500,000 of any property transaction, whether it's your primary residence or an additional investment property. So there are some savings to be had there. And I think buyers will be sort of looking to capitalise on those savings up to around £15,000. So not quite a significant saving there. And obviously those landlords which are very yield driven, that £15,000 saving could really make all the difference, could make a deal work for them. So I think as the market is still adapting, sales are getting agreed, they're going through the purchasing sort of journey of agreeing the legals, searches, and getting that over the line. So like I said, I think May and June will be busier months, and I'm not sure we'll quite see the sales numbers go, sort of significantly above 200 a week like we've been seeing them, but I am expecting a busy couple of months in that period.
Yeah, I think the trend that's coming out the last few weeks and what all this data is telling us, and I've been speaking to all of the agents, and the one thing I'm hearing is lack of stock. And so what you're seeing now is a demand and supply situation that's allowing for price rises because there's a big demand, a lack of supply, putting pressure on pricing. That means whatever comes to the market is able to achieve more money because we've got so many buyers for every single property. On the back of that, and we discussed the data last week, and you can go to handout number two for this week. They've just released the UK household bank deposits and what those numbers look like for the last year. And it's that UK household wealth that rose something like 11.4 trillion rose to 11.4 trillion pounds over the pandemic period, that allows everyone to have excess cash and excess spending that's moving into the property market, and more money is being pulled out of property and real estate in terms of increased borrowing. And I think if you move into handout 3, and we're going to do 2 and 3 together, James, this week, if you look at mortgage borrowing, and we saw record borrowing in March going up to 10 billion plus. I think the number actually was over 11. And that's the highest figure since records have begun. So what I'm seeing here is a lot of refinance, a lot of borrowing, a lot of deposits, house price growth, and all of that combined is creating a fever in the market, a lot of activity, a lot of sentiment, and the nationwide figures also came out. And the Halifax figures also came out with 2.1% growth compared with March of this year. Year on year, nationwide 7.1%, Halifax 6.5%. And also on the back of all of that, we had the Barclays boss, Jez Staley, saying that the built up savings that I've just mentioned in terms of that 180 billion of built up savings over the last year and the increased property prices, the savings and the household net wealth rising to 11.4 trillion puts everyone in a very strong position. And as I said, the Barclays boss, Jez Staley, said that we're going to see the biggest economic boom since the aftermath of World War II in the UK. And the housing market is definitely going to be a key player and a key factor to that. So a lot of points there, James. I just want to know what your view on all of that is and a bit of a summary on that.
Yeah, just to reflect on some of those. So, I mean, in the last 12 months or so since the pandemic was first declared at the start of 2020, I mean, people have spent more time than ever at home, and people's work-life balances have improved in many cases as a result of spending more time at home. And I think that this factor has obviously caused people to, want more outside space. Maybe they've put their money and those savings into buying a bigger home or relocating or changing their lifestyle. And I think obviously this has caused the property market as a whole to really surge in the last 12 months. Which, I think these factors are some sort of rationalisation of the mortgage lending and some of the sort of positive sentiment that's really been coming out of the property market since probably sort of June, July. The property market was extremely hot last year, so getting on for 12 months ago, and we're obviously seeing a slight sort of slowdown in terms of transaction volumes at the current time. As far as we're seeing, this hasn't caused sort of a particular price drop at all, possibly because of the lack of supply, Rob, as you were saying. So the next few months are going to be an interesting one to monitor, and whether people's work-life balances, whether they're sort of the social migration, whether people continue to migrate out of cities and commute in or have more working from home time. We get to see how that impacts on the sort of the inner workings of cities, town centres, and also commuting and lifestyle behaviours.
I want to touch on pure hard economics here, because the fact that net mortgage borrowing in March was 11.8 billion, the strongest since records began, according to the Bank of England that they announced this week. And at the same time, you've got record deposits sitting in bank accounts or people's bank accounts. So record lending, mortgages, record deposits, then lack of stock, lots of demand, and all of those factors combined say to me that we're heading into a growth market and a frenzied market. And then the key determining factor that I repeat time and time again, the only thing that can allow that to continue, obviously inflation has a key role in that, but in pure economic terms, the only thing that can allow that to continue is good employment numbers to ensure that people, one, have money to spend, and two, that property, whether it's purchasing or renting, is the place where people are spending that money. And we are in unprecedented times and market conditions, because it's not normal to have record mortgage borrowing and a record amount of money sitting in a bank account at the same time. You would expect the more borrowing and the more debt people take on, the less deposits would be sitting there. And at the moment, we just don't have that. We've got a rush of people to buy properties and spend their money in that area. And at the same time, the demand and the supply is putting pressure on price growth. And that is going to fuel the market for the next 3 to 6 months for sure. And what we really want to know from a risk and a credit and a sanction perspective is what's going to happen at the end of the stamp duty period, at the end of this year when there's no furlough, and when the crunch happens, if unemployment goes the wrong way and not the right way. What are all those pressures going to create in the market to allow it either to flatten off or to see a downward trend? Because at the moment, in the short term, for all the macroeconomic reasoning I've just given you, it only says it can go in one direction, which is upwards, and something has to change for that to be different. And those things could be, like I just said, the end of furlough, the end of the stamp duty holiday, and unemployment, which is the key point. What are your thoughts on that, James?
Well, just firstly, on terms of mortgage finance, as it being at its highest rate ever, the government is still pushing for more of the UK population to have access to property finance, like we've spoken about, the 95% mortgages. So this figure could actually continue to increase throughout the remainder of this year and in 2022. And just one of the points on the back of that, I think the market as a whole has to function with activity for the market to perform in a positive manner. And it's just how the end of furlough and any rising unemployment rates in the UK could have a negative impact on the market, and how the recovery continues in the UK in terms of the sort of macroeconomics on the back of some of the fiscal measures which have been put into place.
Brilliant, James. What else have you got for us this week, and what have you seen in the news?
In the property market? Well, in terms of the retail and commercial sector, there's a bit of a landmark case recently with retailers are going to be very cautious on the back of the Westfield owner winning quite a landmark property case against the fragrance shop. On the back of this, the fragrance shop did not pay rent over the pandemic period, with unpaid rents of around £160,000 outstanding. And the owners of Westfield, like we say, have won a landmark case to have this rent paid back to them. And it's going to be interesting, the ramifications of that throughout the market and throughout the high street. What happens to retailers? Is it only the blue chip companies that are going to be able to afford those unpaid rents? What are we going to see to the smaller independent boutique retailers? Are they going to be able to afford these back payments of rent? And what measures or government support could be put in place on the back of this landmark case?
Thanks, James. Sorry to go back a point. I just want to add one more point on the numbers we were mentioning. I said there was 180 billion worth of cash deposits that had built up over the last year. And the last month's figures were another 16 billion that takes household bank accounts increasing by 200 billion over the last year. And, do the maths on that. It's something like 15 to 20 million billion, a month. Previous to lockdown, at best, it was at 4.5 billion. So the excess cash and spending and firepower to drive the economy, both on retail spending and through property and acquisition, is huge at this moment in time. And again, like I said, unprecedented. And I think that's where key economic experts see the rebound and the spend, consumer spending and sentiment really driving things, at least in the short term, for the rest of the year. Quick big sell that I saw happen last week. There was a nice 25 million plus in Ellsworthy Road NW3, significant transaction there. Anything else that you've seen that you want to share, James?
Well, there's been some prime sales in the last week or so. There's been a big Wilson Crescent sale of around £20 million in the last week. Some more positivity in the prime central London market. Just highlighting some of that activity of both sort of international buyers and domestic buyers, possibly through the use of buying agents being active in the prime central London market.
Great. And quick point on buy-to-lets. There's been a lot of noise about the buy-to-let market. It has been waning over the last year because of the challenges of rentals in the pandemic and the windows of repossessions that have been stopped, and residents having left London or working from home, and rental prices coming down. And there's a broad inner London decline of average of somewhere around 15% falls in very central London over that period, broadly speaking, across the time. I think a lot of people are reaching out, a lot of the lenders are reaching out to me and asking me, what's going to happen to the buy-to-let market? What happens to those rental yields, void periods, etc., etc. I think it's going to be a really challenging space moving forward, and I think it's going to come under a lot of pressure. And the trend that we're seeing is that a significant amount of buy-to-let investors are looking to exit that market. They've had their benefits, they've had their capital growth, they've had a good run of rental income and yield return, and now the amount of buy-to-let investors, especially in London and surrounding areas where pricing and rental income are going in different directions, are making that less attractive. So I think that's something that's coming to a front, and it's something that a lot of lenders are approaching me directly for and wanting more data, more intel, because obviously a lot of books have a reasonable amount of exposure to buy-to-lets.
Yeah, thank you, Rob. So just following on for some of the retail news on the high street, we mentioned there about the landmark case from the Westfield owners ordering the fragrance shop to repay their unpaid rent for the period over the pandemic. It's obviously going to have some ramifications throughout the rest of the high street market. Just some news which also sort of maybe flies in the face of that. The car park owner NCP is currently an emergency restructuring plan to try and save the group from going into administration, and they're looking to actually reduce their rents by around 25% across the board. Otherwise, they're going to risk, well, they're going to go into administration, from what the reports and speculators are saying. A big employer in the UK, they have 1,000 staff across 500 car parks and sites in the UK. One of many businesses who have obviously struggled throughout lockdown. The high streets are obviously decimated during the lockdowns we've had, with people not travelling into town centres and therefore not paying for parking. So some sympathy there with them. Obviously, the impacts of the pandemic have really captured their business.
I just wonder if that does come into fruition and some of those sites have to close. I'm massively interested into the alternative use for those sites, and I've been banging on about last mile logistics for quite a few months now. I see that as one of the key areas commercially driven. I just wonder whether this excess retail on the high street, this office space, and potentially car parking space, for me, it's got last mile logistics written all over it, on the back of what Amazon are doing and what eBay are doing. I think there's a very, very natural transition there, and I think that's a key space to watch, and I believe that's going to be a sector that's going to go from strength to strength, although the transitioning of those change of uses from office space to high street retail to potentially car parking will take time, but I see a niche there, a general opportunity. What else have you got to close out this week, James?
Well, I just wanted to touch briefly on a subject we have covered a little while ago, and that's ground rents. There's a story breaking this week about a particular flat in South London, East Dulwich, with the current ground rents, quite an expensive ground rent for a small flat of around £1,050 per annum. Under the terms of the lease, this will be escalating over the next 50 years to over £1 million a year just to own the flat, this ground rent. This is obviously extremely onerous ground rents and will impact the saleability and the market value of the flat without a doubt. Ministers in the UK are obviously in the process of a new leasehold reform, but with the sort of parliamentary debates on this unlikely to start until 2022, that this does leave some of these lessees and leaseholders in a very uncertain position. And just if you had any thoughts, Rob, on the sort of future of ground rents and what is their future? They're being more highly regulated in the future, without a doubt. Any sort of predictions or reflection you see?
I definitely see further government intervention in that area, especially on the rogue stroke advantageous or very commercial, let's just say, ground rent activity that has been taking place. I see it as an area that the government are going to want to control or have controlled measures much greater than they are currently, and maybe over time they want to create legislation that just stops profiteering like we've been seeing. So I definitely think that as time goes by and such scenarios of exorbitant and ground rents come into play, there's going to be a need for further action and further legislation on top of that.
I agree. It's going to be an interesting one to see and how that affects those existing sort of freeholder landlords and what impacts it has in the property market. I do think it will be a positive if there's more regulation in that industry, though. I think there's got to be some parameters whereby developers and the sort of the lease conditions are more regulated. So there's not these onerous and unexpected conditions in the lease, which often come to light some years later.
Great, thanks, James. And last thing I want to share with you, had a great session last week with another university, and some of the graduates or students were asking questions in relation to what's the next opportunity or the opportunity to enter into property or lending or finance or real estate. And it's a great question. And the answer I gave was, I think anything that's data-driven, technology-driven, love logistics and distribution, like I just said, last mile logistics, everything around that, love online retailing, innovation of the high street, all of those areas over the next 10 years are going to change massively. So if you're young into the industry or you're looking for that niche or that next go-to area, I think anything around those areas, which are very tangible, and then you've got the slightly non-tangibles, which is climate change, environmental change and sustainability, which I think are huge drivers for the next 10, 20 years of property and real estate. So that's the advice that I gave to the grads and the students last week. Any other areas I've missed out there, James, or anything that you think is interesting at the moment?
I think throughout the market, I think sustainability is a massive factor. Companies are having more of a conscious effort to mould their social responsibility and their sustainability in terms of their sort of carbon footprint. So I think those are some additional areas which are particularly under the microscope present. Brilliant.
Thanks, James, as always. Great data, great intel, great live news. Thank you, everyone, for joining, whether you're live or whether you're on YouTube or you're across any of the other platforms, LinkedIn, Instagram. We will be moving onto a podcast as well, so you're going to be able to get even more intel, data, interviews, and live updates from us moving forward, and we'll share all of that with you on all of our platforms via email or messaging. However we engage with you, you keep asking the questions, we'll keep giving you the answers, we'll keep on sharing with you week after week after week after week what is happening now, not what's happening in 3 months or what's happening in 6 months, or what happened 3 months ago, what happened 6 months ago. What we are seeing, what is happening now, we'll keep sharing with you every week, 1 p.m. every Wednesday, #AskRobCo. Have a great week, everyone. Take care, be safe, be well, and we will see you same time, same place next week. Thanks, James. Take care.
Thanks so much, everyone.